You know, people always ask, is the stock market just a big, flashy casino? A place where you get lucky or you don't? Well, today, we're going to tear that whole idea apart. We're going to show you how to stop gambling and start playing the game like a pro. All right, let's get into it.
And this quote right here, it just hits the nail on the head. The moment you start making these short-term emotional bets, you're playing a game you're almost guaranteed to lose. And it's not just about bad luck. You're fighting against the system that has all these hidden costs designed to chip away at your money over time.
So here's how we're going to break it all down. First, we'll look at the casino trap itself. Then we'll see why the house, and yes, there's a house, always wins. After that, we'll open up the professional's playbook, looking at their defensive and offensive moves. And we'll wrap it all up with a final showdown, gambler versus speculator.
Okay, first section. Let's really dig into this idea of the market as a casino. It's a super common way to think about it, but it's also a trap. And figuring out why it's a trap is your very first step to building a strategy that actually works.
This right here is the core concept, a negative-sum game. See, in a regular game, one person's win is another's loss. That's zero-sum. But in the market, when you're trading a lot, it's different. Every time you buy or sell, little costs get taken out. So it's not just you against another trader. It's you two trading, and the house is taking a slice of the pot every single time.
So, if it's a negative-sum game, who's actually winning? The house, of course. But here's the twist. In the stock market, the house isn't just one guy in a suit. Oh no, it's a whole combination of things that are all profiting from your constant trading.
Any strategy you come up with, no matter how brilliant, has to climb over these 4 massive hurdles just to get back to zero. I mean, think about it. You could have a great idea for a trade, but slippage, broker fees, and taxes can eat away at your profit before you even get started. It's a huge barrier you have to clear just to break even. And here is the brutal truth of what that barrier does. Get this. Even if you have a strategy that's right 55% of the time, which is pretty darn good, you could still end up losing 2 to 5% of your money every single year once you factor in all those costs. That right there is the casino trap in action.
So, who are these guys getting your cash? Well, the house is your broker who charges you fees. It's the market maker who profits from the little difference between the buying and selling price. And of course, it's the government, waiting to take its cut in taxes. All of them make money when you trade a lot, whether you win or lose.
Okay, so that was the bad news. It sounds pretty bleak, right? If the whole system is set up for the frequent trader to lose, how does anyone ever make money? Well, here's the good news. The professionals, they don't play that game at all. They've got a completely different playbook. Let's open it up.
It really boils down to these 4 pillars. These aren't some crazy secrets. They're just disciplined, smart rules that flip the odds back in your favor. We're going to split them into 2 parts. The defensive plays that protect your money and the offensive plays that actually make you money. All right, let's talk defense first, because honestly, the #1 rule is just staying in the game. You can't win if your account is at 0, right? So these first 2 strategies are all about survival.
Position sizing is maybe the most important and most overlooked rule in the book. It's not about what you buy. It's about how much you're willing to risk on that one idea. This is your #1 shield against one bad decision blowing up your entire portfolio.
And here is the golden rule, the one the pros live by. You never, ever risk more than 1 to 2% of your total capital on a single trade, period. This means you can be wrong, and wrong again, and wrong a dozen more times, and you'll still have plenty of cash left to fight another day. This discipline is what separates the pros from the amateurs. The second defensive move is hunting for asymmetry. Basically, you're looking for bets where the potential reward is just massively bigger than the potential loss. This way, you don't have to be right all the time. You can be wrong 8 out of 10 times, but if those 2 wins are huge, they can more than pay for all the small losses. It's about the quality of your wins, not the quantity. Okay, our defense is locked in. We know how to survive. Now, how do we actually score some points and grow our account? Let's flip over to offense. This is where patience and data become your best friends.
Believe it or not, just being patient is profitable. I mean, it's literally written into the tax code. The government actually rewards you for holding on to your investments longer. Just by holding something for more than a year, you can give yourself a massive guaranteed raise on your net returns. And this chart just makes it crystal clear. Look at that difference. Short-term gains get taxed like regular income, sometimes at 30, even 40%. But if you hold for over a year, that rate can get cut in half. That is a huge amount of your own profit that you get to keep just for being patient.
And finally, the ultimate offensive weapon, a real statistical edge. This is where you stop trading on gut feelings and hot tips, and you start trading based on data. You find patterns that have a high probability of happening again, things like momentum or mean reversion, which is just the idea that prices tend to snap back to their average over time. This is how you leave the world of luck behind and enter the world of probabilities.
All right, let's bring it all home. We've seen the gambler's losing strategy, and we've walked through the professional speculator's playbook. Now let's put them head-to-head and see just how different they really are.
This table says it all, doesn't it? The gambler is all emotion, betting big on hunches and chasing quick little wins. The smart speculator? They are disciplined. They manage risk with strict sizing rules. They hunt for those huge asymmetric payoffs. They think long-term to save on taxes, and every decision is based on a statistical edge. They are playing completely different sports on the same field.
And that's really the big takeaway here. This isn't about avoiding risk altogether. That's impossible. It's about managing it so intelligently, so methodically, that you turn what looks like chaos into a game of probabilities that you can actually win over time.
So I'll just leave you with this one question to think about. Their game is the casino, the one set up by the house for you to lose. Your game is the patient, disciplined, strategic approach of a professional. So, which game are you going to play?